Welcome to the Sage Planning Solutions Podcast. Join Brad Marshall, Patrick Bennett, and Dominic Ruiz as we help you navigate life's financial obstacles and find financial freedom.
Securities and advisory services offered through Catteray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Catteray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Catteray Grant & Company Incorporated. Investing is subject to risks including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Catteray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominic Ruiz, and I'm joined by my two co-hosts, Patrick Bennett and Brad Marshall. In today's episode, we have a special guest, Mr. Mark Zinder. Mark, thank you for joining us.
Well, it's a pleasure to be here. Thanks for the invitation.
Pat and I have been following you for a couple of decades. Please just share with us some of your experience. Tell our listeners a little bit about yourself, your experience that you've had with Mr. Sir John Templeton.
Mr. Templeton, I'm from Tennessee. I'm from Nashville. And Mr. Templeton is from Tennessee as well. And it's very interesting how I met Mr. Templeton. And then I'll tell you a little about who he is and what I did for him. But the very first time I met him was December of 1992. I had just been hired. And they thought, oh, Mr. Templeton's speaking in Orlando. You should go listen to him speak. And so you know how it is at conferences where there'd be these round tables, and there's maybe 30 or 40, and a lot of people coming to hear Sir John speak. No one's sitting up front. And so I sit up front, but the round table. And half the audience that are sitting at the tables are pointing towards the back of the room. Never makes sense to me. So I grabbed one of those seats, and my wife is to the right of me. And I hear this gentleman say, hey, do you mind if I join you? And I went, no, not at all. And it's Mr. Templeton, and he sits down right next to me. Now, everybody in the room knows who Mr. Templeton is. The greatest thing about Mr. Templeton, he was so humble. He had his name tag on. And so I was like, oh my gosh, it's Sir John, right? He is so kind. And it's all about me. He's not about him. It's about me, where you're from. And I said, Nashville. He goes, oh, I'm from Tennessee. And I said, oh, what part? And he said, I forget the name of where he went, but my wife has relatives in the same town he's from. So my wife, oh my gosh, I have relatives there. Well, they start comparing notes, and they have common friends, and that's how I met Sir John. I'm in the middle, like watching a ping pong match, and that's how I met Mr. Templeton. So Mr. Templeton from Tennessee, and he was knighted in 1987. Even though he is from Tennessee, he has a dual citizenship. And he was a London citizen as well. And he lived in Nassau, which was a British territory. And he was knighted in 1987. He is the founder of the Templeton Prize for Progress in Religion. It is the largest financial gift given every single year to that one individual who has advanced religious thinking. Mother Teresa was his first recipient. Whenever we had a meeting at Templeton, he would start the meeting with a prayer. And he said, at Templeton, we pray before we buy our stocks, not after. So that was Sir John. I love that. I also work with a gentleman named Dr. Mark Mobius. And Dr. Mobius has 2 PhDs from MIT. Now, my job is to sit down with these brilliant money managers. They would tell me how they saw the future in the economy, and then I would travel the world and I would speak on their behalf. But they were left brain analytical, and I'm a right brain storyteller. And so when I sat down with Dr. Mobius, I said, Dr. Mobius, man, you got to talk to me like I was in 12th grade. And so my job was to sit down with and also a guy named Michael Price. And Michael Price, on the list of top 10 money managers of the 20th century, Sir John's number 3, Michael Price is number 8, Dr. Mobius is number 10. And I sat down with Dr. Mobius once and I said, Dr. Mobius, and by the way, the market since 1896 has averaged just a tad bit under 10%. This is through wars and depressions and recessions, so 10% is your average. Sir John had averaged just about 15%, and Michael had averaged 17.5%. And so I sat down with Michael and said, teach me something I don't know. And he said, do you want to learn how to manage money? And I went, well, yeah. And he taught me how he did it. So my job then was to travel the world and speak on their behalf. And it was a great job.
How many years did you work with Sir John?
I worked with the Templeton organization for 12 years and 6 years as his national spokesman.
So this is a sort of a loaded question, but what did he teach you And there's lots of stuff about finance that I'm sure we're all craving to know. But what are the one or two sort of life things that he taught you about money and what does money mean to him and that sort of thing?
There's so much. As a matter of fact, I had mentioned to y'all earlier that I had been on Fox Business, and it was the time that Israel had started its ground war in Gaza, and Liz Clayman, the host, turned to me and said, what are we going to talk about? I said, I used to work for Sir John. This is his type of market. She said, we're going with that. And so we did, and it was a great interview. And they invited me back saying, let's just talk about the things that Sir John taught you. And I learned so much from him. But more than anything else, I want to go back and teach you what not to pay attention to. That's a weird way of saying this. In March of 2022, we're coming out of this COVID period. Oil prices went from negative. Do you remember when oil prices were negative? They were negative $37 a gallon. And then it went to 130. In March, it was March 7th of 2022. And the news from the Wall Street Journal and Barron's was oil is going to $200 this month. Like in 3 weeks. Now, it didn't go to 200, it went to 100. But my question was, I looked at the person who wrote the articles, and you could follow her. And so I said, I'm going to follow her and read up on her. 33 years old. Let me ask you, does she have a degree in economics? No. Does she have a degree in finance? No. Does she have a degree in journalism? Yes. So these people who really don't understand our industry like we do are writing these articles that our clients are reading, and then they call us and go, I just read that oil is going to $200 a barrel. Didn't happen, right? Oh, by the way, barrel, BBL. Please tell me why the abbreviation for barrel is BBL. There aren't two B's in barrel. There are two R's in barrel. It should be RRL. Do you know why it's BBL? Here's the reason why. When J.D. Rockefeller was shipping oil using Vanderbilt's railroad, he was buying barrels from wherever he could get them. Some would hold molasses, and some held chickens, and some held cotton, but they would leak. And so a barrel should have 42 gallons in it. By the time it got to a destination on the train, there was only 40 gallons in it, sometimes 38. And people were complaining, not fair, not fair. I bought a full barrel. So he started building his own barrels, making them watertight, and he painted them blue. And if you got a blue barrel, you knew that you were getting a standard barrel of oil, standard oil, BBL. That's where it comes from. What Sir John taught me when I was made his spokesman, and the first time I heard him speak in December of 92, I was listening to him speak. I've been in the business a long time, and I'm thinking to myself, oh, Mr. Templeton, I'm sorry, but you are so wrong about this. And he was right. It turned out he was right. So in my mind, I'm thinking, oh, he got lucky. Then I heard him speak again, and he made another prognostication about the future. And I went, I don't know, Mr. Nelson. you got right again. You got lucky again. Oh. And so then 3 years later, he invited me to be his spokesman. And I said, Mr. Templeton, you got to teach me how you do this. And by the way, there's a magazine called Equities Magazine, and they interviewed him every year for 22 years in a row. And it was an institutional magazine, and a lot of people got the magazine primarily for this summer interview with Sir John. And they said, okay, we're curious. In the 22 years we've been interviewing Mr. Templeton, how many times was he right? And how many times was he wrong? They have 22 years of articles, and they go back and they discovered he was wrong once in 22 years, once. And that was 1999 when he said the overpriced stock market will quickly crash, and he was a year early. That was the time he was wrong. When I was made his spokesman, I said, Mr. Templeton, this is it. How do you do it? And he said to me, what do you read? And I said, well, I read the Wall Street Journal. I read Barron's. I read, Business Week and Forbes. He goes, oh, good. You're reading the same thing your clients are reading the same day they're reading it. And then he leaned over and he pulled up this report. And I said, what is this? And it's a report from the Federal Reserve. He said, are you reading this? He said, let me explain. It happens here first. Federal Reserve, U.S. Treasury, National Bureau of Economic Research. And what happens is a reporter reads this and goes, oh my gosh, I need to do a story about this. And the editor goes, okay, you're in charge, you do that. And then the reporter spends 4, 6, 8, 10, 12 weeks working on it, brings it back to the editor edits it and puts it on the front page of the Wall Street Journal, and all of us read it at the exact same time. Wouldn't it be cool if you could see it before it's obvious? And so that's what he taught me. So the question a long time ago was, what did you learn from him? And that is, I spent a lot of time reading reports for the Federal Reserve, U.S. Treasury, National Bureau of Economic Research. And it's complicated. I mean, it really, really is complicated, but that's where I get my information from. I get it directly from the source.
We'll get questions. Did you see the news? And most of the time I'll say no, because, this and that is happening. I'm like, okay, well, I don't want to read what everybody else is reading. And typically, right, as you had mentioned about the reporter, did she major in economics or finance? No. Journalism? Yes. From a technical perspective, not fundamentally, anytime Barron's or The Economist has whatever they have on the cover of their magazine, we kind of want to do the opposite. It's almost right, perfect timing, and it's being written by a journalist who has no experience about what they're speaking about other than the consensus from the consumer sentiment.
Here's my favorite quote from Sir John. Bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. And when I read articles like in CNBC, reading the headlines, they can have two headlines, one right next to each other, that are completely competing with one another. And so you have to remember, these reporters today aren't doing the investigation they used to do 15, 20, 30 years ago. They're writing 15, 20 articles a day, and they're just feeding you information that they think you want to hear. You know, it's all about eyeballs. And I've even read that headlines with a negative word in the headline gets more clicks than those with a positive headline.
Yeah, just as the negative pessimism is twice as impactful as positive sentiment.
It dumbs down the readership in the audience. Do you remember Hirsch Cohn from Smith Barney all those years ago? Does anything ring a bell with you?
I don't know.
He would come out and hang out with the little people every now and then. He would just say something like, one of the ones is, he would say, hey, the easy thing to do is almost always the wrong thing to do, and the hard thing to do is almost always the right thing to do when it comes to investing. Yeah. That one stuck with me and always will. The other one was, he would say, believe nothing of what you hear and only half of what you read.
Absolutely.
And now, exactly to your point, is journalists used to produce journalism. And now I feel like it's just filler. It's something's like, hey, we have column inches to fill and we have screen time, to fill up. And the problem is there's so many different outlets that there's no reporting. In my understanding, there is just, hey, here's our bandwagon. Do you want to hop on it? Hey, this is popular. Let's make our bandwagon bigger. And so we're just talking about stories and nonsense. And to hear what you're saying, Mark, it just feels really good, because it's sort of what we've hung our hats on for years, which is when people say, hey, did you hear the story? It's like, no, we don't. Mm-hmm. That's amateur hour. It really is. I hope you found it entertaining. Anyway, how are your kids?
Oh, well, thank you for asking. Yeah. I have 3 brilliant children. Don't know if you remember the name Lamar Alexander, but he was a governor of Tennessee and a senator as well. He was the education czar, I think, under Clinton. Uh-huh. And so he created something called Magnet School. And Magnet School, do you have them in California?
Oh, yeah.
All right, so they attract the best students and the best teachers.
I'm a victim of one, yeah.
And you have to be tested. You test in, you just don't get to go. Going is all based on your ability. It has nothing to do with socioeconomics, your wealth, your connections. It's just, can you test in? And all 3 of my children went to MLK High School, which is focused on math and science. I went to the school maybe 3 or 4 years ago, just before pre-COVID, and they always put the best schools in the worst neighborhoods. And so they buzzed me in, and there's security there. And they, can we help you, sir? And I said, yes. I want to speak to the principal. And they walked me to the principal's office. She comes out. Can I help you? You know what? Yes. She goes, what can I do for you? She said, I've come to say thank you, because my son has more degrees than a thermometer. He's an actuary. He's a mathematician. He's a statistician. He's an econometrician. He's a data scientist, and he works in AI today. And gosh, he's brilliant. The last time he was home, I just happened to say, oh, man, what are the odds? He went, I can calculate that for you, Dad. And then my daughter's also a mathematician. She teaches applied mathematics in a community college. And then my other daughter's a chemist. She works in the biochemical field in San Diego. They're all just brilliant. And of course, we talk. I don't have a clue what they're talking about. But thank you for asking about my kids. They are wonderful children.
Well, here's the sort of segue. We're in sort of an interesting I don't know if it's a transition. I don't know if we're at the beginning, the middle, or turning the corner. But where do you, and I don't really want you to look into the future. I kind of just going after your feelings based on your experience. Where do you feel like we are now? And this is going to have less to do with the economy and more just kind of do with America. Where do you think America works in the current and future world?
When I was growing up, I had a younger brother, and he never spoke. He never said a word. I had a lisp, by the way. And when you're a child, other children can be cruel. And whoever invented the word lisp and put an S in it should be shot. So when you're 4 or 5, your greatest fear is turning 6. After that, it's 7. and then it's like, oh my gosh, 67 is going to be a nightmare. So today I'm 67. But my younger brother never spoke. He never said a word. And we brought him to specialists and doctors, and he never said a word. And then one day we're having dinner, and he said, Mom, this soup tastes terrible. And my mom, oh my gosh, you talked. Why after all these years, why haven't you said anything? And he said, well, up until now, everything's been okay. Right. I love the quote from Lenin, and this isn't John Lennon, this is Vladimir Lenin. I think it was 1917, when he said, there are decades where nothing happens, and there are weeks where decades happen. That's where we are today. These are interesting times, but working again for John Templeton, he was always optimistic. And he would say, don't ask me what's going to happen in 3 days, 3 months, 3 weeks, 3 months. Ask me what's going to happen in 3 years. And so I carry that optimism with me, and I am optimistic that the future will be bright for our country and for the stock market as well.
Yeah, it's tough to bet against the United States. Our eye line gets drawn away from maybe the critical issues or maybe the issues that are truly impactful, and we look at the shiny objects instead. I'm glad to hear that. It reminds me a lot of, you remember Nick Murray? He was sort of an acolyte, right? Yeah. And he was always sort of a, hey, what kind of stocks do you recommend, Nick? And he's like, red, white, and blue. That was sort of his way of going about it. The three of us I think we're all optimists, but we have to use a healthy dose of pessimism in sort of our calculus when we're looking at things. And the American bond market sort of is the euphemism is the cleanest dirty shirt. And I think that's a great one because it's at the end of the day, other central banks around the world, they go, hey, we still got to we don't want to hold pesos or reals or slackas. We need to hold our cash in something else. And when other countries' central banks believe enough in our U.S. Treasury bond, it's absolutely heartening because all the noise and all the headline grabbers and all the punchy statements, it just sort of, I just really glad that you're bringing it back to fundamentals and basics like you are.
And let's talk about that and kind of work our way into inflation because that's top of the news right now. And that seems to be a major concern for a lot of people. And Sir John, Michael Price, Dr. Mobius, they were all fundamental investors. They used something called, it was Graham and Dodd investing using price to book. What is the breakup value of this company? And Sir John, if that's one thing he taught me is what is its value? What is its valuation? Break it apart. And don't know if you know how this all got started, but it was Benjamin Graham, 1913, graduated from Columbia University and went to go work for a Wall Street firm. I said it was 1917. Went to go work for a Wall Street firm. And he noticed there was a stock called Guggenheim Exploration Company. And they mined copper out of Denver, Colorado. And they announced they're going to close their doors, cease their operations, sell their assets, and return the money back to the shareholder. Now, the stock's trading at $69 a share. And Benjamin Graham said, well, what are the assets worth? Nobody knew. It was before full disclosure and SEC and NASD. It was before rules, right? And so he goes back to Columbia and starts doing research on what is the breakup value of this company? What is the value of their copper? What is the value of their equipment? What is the value of their real estate? What is the breakup value of Guggenheim? Now, the stock is trading at $69, and he adds it up, and he comes up with $78 a share. Right, there's a $9 arbitrage share. And he goes to his boss and says, look what I discovered. And the boss said, well, let's buy 10,000 shares. Let's see how you do. Benjamin Graham, he's a kid. He's like 23 years old. He says, I want 20% of the profits, right? First hedge fund manager. I want 20% of the profit. And his boss said, okay. 4 weeks later, Guggenheim closes its doors. Over the next 4 months, they start selling off their assets, and they got exactly what Benjamin Graham had predicted and said, can you do it again? And that's when he started doing quantitative research based on what's the breakup value of these companies. I'm a value guy. I look up, Mr. Templeton taught me how to value real estate. He taught me you can put a value on just about everything. So what is the value? That's what he taught. What I'd like to do is, because right now the press, as we've spoken about earlier, is all about inflation. And inflation numbers came out this morning. And PCE, which stands for the Personal Consumption Expenditure Price Index, came out today. This is the one favored by the Fed. And understand why this is important. Do you know how they come up with CPI? One of my best friends is an economist at the Federal Reserve. He's a senior economist. And he said what they do with CPI is they send the same people to the same stores every month to pick up the same item. And they go, okay, last month it was $1. And then this month it's $1.02, and they write it down. They bring all the information in, they add them up, they average them out. That's how CPI is calculated. PCE, which was created by Alan Greenspan, and of course he would call something the Personal Consumption Expenditure Price Deflator Index, like PCE. It's okay. It was $1 last month, and it's $1 this month. Have you noticed that there's less water in the bottle? That needs to be calculated. Have they gone from a 4-color print on the label to a 2-color? That needs to be calculated. Is the top thinner, smaller, the plastic thinner? That all needs to be calculated. And that's calculated in PCE, where it's not calculated in CPI. Also, shrinkflation, which is very popular today. And we all know they're putting less product in the package. Have you gotten a pint of ice cream lately? And as you get down towards the bottom, there's an air pocket in the bottom. And you go, hey, what's that air pocket doing in my ice cream? Let me tell you what's happened. Ben & Jerry's could make a smaller carton, but then they have to make a smaller box that those cartons go in, and then a smaller master box that those boxes go in, and then they have to redesign how they assemble the boxes in the 18-wheelers they transport. So what they do is they fill it up about 90% of the way, and then they turn it upside down. And it frees it upside down. So when you open it, it looks full, but there's an air pocket in the bottom, which is what we call shrinkflation today. And on the little note on the shelf, they'll do the numbers for you, but the average American can't do numbers. They can't do the math. And so we're fooled by the size of the bag. They're not cheating because they're telling you exactly how much is in there. We can't do the math.
Quick question as terms to inflation. And I've heard you talk about this before, but I would love to get it, spoken again from you. I don't want to say on the record, but you were talking about what is the GDP and what is our debt to GDP. I'm like, okay, well, let's take a look at our assets. Let's take a look at American assets, right? Yeah. No one ever, in my experience, has ever said it like you have said it. I don't want to put you on the spot.
No, I appreciate it.
If you know where I'm going with this.
Absolutely. Let me remind everyone that as a speaker, I left the Franklin Templeton organization in 2004, so I've been speaking professionally now for 24 years, and I'll do between 80 and 100, sometimes 120 speeches a year, which is a lot of flying, right? People don't pay me to speak, they pay me to fly. When I do Q&A, the very first question I always get is, what about our national debt? That's always number one. No one ever asks me, what about our nation's assets, right? So I'll bring that point up, is let's talk about our national debt today is, and help me out here, about $33 trillion. You may remember that back 10, 12, 15 years ago, that 2 PhDs, one from MIT and one from Harvard, wrote a paper saying when a country's debt to GDP exceeds 90%, then that country goes into a recession. And so our debt to GDP is approaching that 90, a little bit over that 90% range. However, there's a guy named Mark Herndon. I forget his. He's a PhD student at UMass Amherst. And when you're getting your PhD, they ask you to replicate papers that were done before. And so he was given this paper from Reinhardt and Rogoff about debt to GDP. And he tried to replicate it, and he couldn't make the numbers work. And so his girlfriend was also getting her PhD in economics, and he gave it to her, and she couldn't make the numbers work either. And they went back to Reinhardt and Rogoff, the 2 PhDs, and said, can you give us your data so we can have it. And they sent him their data, and he found mathematical errors, coding errors. Basically, he discovered the paper was false. They've since pulled the paper, but we still use that number today. 90% of GDP. That's not a good number. So when I ask the question, what are our nation's assets? You may not know this, but the United States owns like 26% of all the real estate in America. They own 46% of all the real estate in California. You all live in California. Have you seen California real estate prices? They own like 80% of all the real estate in Nevada. They have oil rights, leasing rights. They have infrastructure. They have levees and dams, and they have above ground and below ground. And so you add it all up. And of course, I'm not saying we're going to sell it all, but you add it all up. Remember, our deficit is about $33 trillion, 34 maybe, some in that range. Add up the assets, $278 trillion, plus $5 trillion of income, which is taxes. So if you were a banker, and I said, I've got $278 trillion in assets, I got $5 trillion in income, I got $34 trillion in debt, would you make me a loan? Yes, you would. We always focus on the deficit, got to focus on the assets as well.
The word trillion is still a new one for me. I'm not going to. Sometimes I'll write 2022, 23 on checks, which is a red flag, so I'm still using checks. But it's also when multimillionaires to decamillionaires became nothing compared to billionaires, and now we're talking about trillions. I was talking to Dominic the other day, like, where does all this money come from? And I get it's an inflated value. And I don't want to go too far down the road on this, but it's sort of like, where does it all stop? How much money? You know those globes where you have the little forest inside the glass globe and they put a little bit of water in there, they seal it, you put it in the light and the moisture comes up and it drips back down and it's this little, its own little private world. Does it work that way with money? How does the money supply keep expanding through wealth creation? This is a Milton Friedman question. I don't know, but it just sort of staggers the mind. And you kind of think money just doesn't seem worth that much as it did 20 years ago.
I want to do two stories. Okay. First one, million, billion. All right. What's a million? What's a billion? And then I want to talk about my favorite story that I share. This is my favorite of all time. And that story has to do about 2 or 3 minutes of economics. And then I'm going to share a story that you just will not believe. And everyone's going to love this story. So what's a million? What's a billion? A million steps is New York to Boston. A million inches is the island of Manhattan tip to tip. Now, if the day you were born and you counted 8 hours a day, you wouldn't be able to count to a billion. A billion seconds ago was 32 years ago. A billion minutes ago was the dawn of Christianity. A billion Coca-Colas ago was yesterday morning. My favorite story of all time, and about monetary policy. 3 minutes of economics. I'm going to make it as simple as possible, but you'll get it. Inflation, deflation. Which is worse? Deflation is worse. Now, wait a minute. That flat screen TV, it was $10,000 when they first came out. Now I buy them for $300, right? No. Imagine if you're a farmer and you plant seeds in the ground today. You're not going to harvest your crop for months. And if during that period prices have come down, when you go to sell your crop, you won't get as much for them as you anticipated. That's bad for you. What if you're a manufacturer and you buy raw materials today and it takes you months to turn it into something you can sell? When you go to sell it, if prices have come down, that's bad for you. Well, how would you get out of deflation? You would inflate your monetary system. You'd print more money. Printing money is inflationary. Think about COVID, how we printed over $2 trillion to keep people working and alive and whatever. And then we saw inflation immediately after that. Printing money is inflationary. Here's the issue. Post-Civil War, from the mid-1860s to 1900, the United States went a 35-year deflationary period. Well, how would you get out of deflation? You'd print more money, but we couldn't do that because our monetary system was built on the gold standard. You can print 4 paper dollars for every 1 gold dollar you had in reserve. Where's the problem there? California gold rush, 1849. We pulled more gold out of the ground in 3 years than the previous 300 years combined. Supply and demand. what's happening to the price of gold. It's going down. So we want to get out of deflation, but we can't because our monetary system is built on the gold standard. Everybody with me? 1898, I think it's 96 or 98, Democratic Convention. Williams Jennings Bryan is running for president. He's a populist. He is suggesting we get off the gold standard. He does a speech at the Democratic Convention that gets the crowd all riled up. And he says, "You shall not press down upon mankind this crown of thorns. You shall not crucify mankind upon this cross of gold." What he was saying is we have to get off the gold standard. And he suggested we go on a bimetal standard. He wanted to peg 16 ounces of silver, which was stable at the time, to an ounce of gold, which was volatile. Stabilize the system, print more money, get out of deflation. Makes sense? 1900, a man writes a book about it. And the man's name is Frank Baum, and the title of his book is The Wonderful Wizard of Oz. Oh, you thought that was a children's story. No, it's a social commentary on monetary policy dating back to the 1890s. Wizard of Oz, OZ, ounce of silver, ounce of gold, follow the yellow brick road. The golden road paves to where? The Emerald City, Washington, D.C., where they printed the greenback at the time. Dorothy was a real person. Her real name was Leslie Kelsley. She was from Kansas, and her nickname was the Kansas Tornado. She was this activist, right? She was this firebrand. In the book, Dorothy passes by the scarecrow representing the American farmer. The Tin Man with his gold and silver axe was the American industrialist. The Cowardly Lion was William Jennings Bryan. The Winged Monkeys were the American Indians. The Munchkins were the little people. In the book, Dorothy's slippers are made out of silver, but because Technicolor was invented in 1937 and the movie produced in 1939, they made them ruby reds. They would jump out at you. That is not a children's story. It's a social commentary on monetary policy dating back to the 1890s. Now, I know everyone's going to go right away. We're going to Wikipedia. We're going to Google this, right? The book was called The Wonderful Wizard of Oz. The movie was called The Wizard of Oz. So if you want to learn more about this, I want you to Google The Wonderful Wizard of Oz as an allegory for monetary policy. Everything will pop up. There it is. In America, they've been keeping inflation rates since 1917. During depressions, World War I, World War II, Vietnam, the Great Reset, what has been the average inflation rate in America since 1917? 3.3%. What did inflation come in this morning? 3.3%. So we're at the historical average. Here's my question to you. Why do they have a 2% target? Have you seen the mathematical formula for 2%? No, because there isn't one. Here's what happened. 1989, there was an economist working for the central bank in New Zealand. His name was Arthur Grimes. And they were dealing with low double-digit inflation, 11, 12%. And they created something called inflation targeting. They thought, okay, maybe we can talk it down and tell the public that we're serious about getting inflation down. So Arthur Grimes came out with a slogan, 0 to 2 by 92. That's where it comes from. It rhymed. It was rhymed, and that's what the two. So what happened? It worked. It worked. By 1993, inflation had come down to 2%. The UK embraced it, and it worked. And then Canada embraced it, and it worked. And now we've embraced it. Right? It's a made-up number. So we're at the historical average. Now, the reason why they are being so definitive about 2% is that because during the Nixon administration in 1972, our Federal Reserve chairman was a guy named Arthur Burns, and he was influenced by Richard Nixon to lower interest rates before the re-election. And he did, and he shouldn't have. And then we saw inflation take off. And so today, Jerome Powell wants to make sure he doesn't make the same mistake that Arthur Burns made in 1972. One last story. Because I don't know how long y'all want to go for, but
if you have energy, we'll go.
As you can see, the Department of Energy has been keeping the price of gasoline since 1978. So if I said to you, let's take an average of all three grades since 1978, all the way through right now, what was the cheapest year for gasoline during this 46-year period?
On an inflation-adjusted basis?
There you go. All right. So in 1978, it was 65 cents a gallon. Adjusted for inflation, $4.27. And you can go through the paperwork from the Department of Energy and you go year by year. Every year starts with a number 4. We've been paying about $4 a gallon for 46 years. And so let me see, I did the research before I got on today. What is it today? As of today, $3.72. It is cheaper today than it has been in 46 years. Again, wow. That is all 3 grades an average. Isn't that interesting? Does the press report that? No.
All they'll say is, it's $6.50 a gallon in California.
Oh, that's right, California. Sorry.
We're special out here. We demand more, so we charge more for gas.
My daughter lives in California, and so
I'm sorry.
I don't get it. I don't understand.
Poor lady.
So for all your listeners outside of California, because in Alabama it's $3.05, in Nashville for regular, in Nashville it's $3.29, and of course y'all are paying $5 or $6 a gallon.
Brad, what is it over there in Idaho?
$3.22. Well, Costco. I mean, I always get it at Costco. It's probably about $3.50, $3.60 at some of the other places, but $3.22. We just got back from a road trip, and it's funny. We were crossing the border into California, and it said last stop before California prices. And so, and they weren't kidding. They went up probably about 60 cents, and that was on the outskirts. So, and we've been in Idaho for a year now, and so it was shocking to see the total. I look less at the per gallon as opposed to how much it costs to fill it up. And I don't miss California. I don't miss California prices, I should say.
My daughter, as I said, lives in San Diego. She drives a Miata, so she gets like 35 miles to the gallon, so she's happy with that. When she moved to California, she had bought a new car. It was a used car. It was a used Miata. And we're talking about COVID here. She wanted me to ship it to her in California. And it had about a dozen of those little hail-damaged dings in it. And so I thought, I'll have the dings taken out for her before I send the car, So I went online and found the ding removal guy. I'll come to you, right? And I went, hey, okay. So I called him. He said, do me a favor, take a picture of the car and then count how many dings there are and then send it to me. And so there were 12. I sent it to him. And so I didn't hear back from him. So I call him. It's Friday, and I'll call him. Are you gonna come take those dings out of my car? And he went, I'm not making this up. He went, I don't want to do it. I said, but this is what you do. He goes, yeah, I don't want to do it. So you know what I said?
What?
I said, okay. Well, what do you say to I don't want to do it?
Yeah, nothing. I mean, what can you say?
The juice is not worth the squeeze. We're all paid a lot of money to sit around the house and watch TV.
The thing is, Jerome Powell said, we're recovering, but we're recovering to a different economy. I don't know if y'all are much into history, but I studied the plague in Europe from 1347 to 1352. And we all know that roughly half the population perished. Now, just like the plague in America recently, COVID, it wasn't evenly divided. The wealthy landowners and nobles went to their country estates, and so it was about 30% of them, and then about 70% of the servants and serfs and peasants, they died. And here's a story, I'm not so sure if it's true or not. They were discovering that people were drinking their ale out of these tin goblets. And the combination of the alcohol and the tin would make them pass out drunk, stone drunk. And so they were burying them alive. Well, they were running out of space to bury these people. And so they went buried up old coffins and put them in old coffins. And they discovered there were fingernail marks at the top as people were trying to claw out. And so as they said, okay, when they buried someone, they tied a string around their finger and up through a hole through the coffin, up to the ground, to a little T-ring with a bell on the end of it. And in the middle of the night, if someone woke up, they would ring the bell and you would have a dead ringer. And the person in charge of spending the night in the graveyard to make sure that they didn't have any dead ringers, had the graveyard checked. So so now the rule was if you saw someone dead on the street, you had to bring them to your house and lay them out in your house to see if they woke up. And then after 3 days, if they didn't wake up, they'd bury them. And that's where the term holding awake comes from as well. So 1347 to 1352, half the population perishes in Europe. Now, I want to put that number in perspective for you. Look at all the wars, all the famines, all the issues that happened in Europe during this 500, 600 year period, about 3.2%. So half the population perished in Europe. Here's the problem. You have two types of assets. You have physical assets, and you have your tangible assets, and you have your human assets, right? Human assets, they're gone. 70% of the peasants and serfs, they're gone. Your physical, tangible assets are still there. The problem is guilds were closed, right? If you were a cobbler, a shoemaker, your father was a cobbler. His father before him was a cobbler. His father before him was a cobbler. They didn't open up the guild to new cobblers. Well, now all the cobblers are dead, but the tools still exist. So they open up the guilds, and new people are coming in and not just making shoes, they're making vests and saddles and other leather goods, and all of a sudden they're creating wealth. Now the landowners, a lot of the landowners died, about 30% of them, and so this land was being subdivided and being sold off. And the very people that used to work the land were buying the land. And this to the nobles was so wrong on so many different levels. You're not supposed to have wealth. Not only that, but they would say, okay, I want you to till my ground. I want you to do my farming. And they would ask for more money. And the landowners were going, you a peasant? You're going to ask me how much I'm going to pay you? And so they went, okay, no problem. I'll go to the neighboring shire. That'll pay me more money. So they made a law, and it was the law of laborers, and it was a maximum wage law, and it was the most a peasant or a serf could charge the landowner. And the peasants went, all right, if that's the case, then I need help. You need to give me an ox. And so they gave an ox, and now productivity is starting to improve, right? A lot of times, these peasants and serfs would go from town to town looking for more work, and they'd happen upon a town, and everybody was dead. But the church, the keeper of all the books, they would take these books and go, oh my gosh, number one, I want to read these books. I need to learn how to read. Number two, the books didn't have spines or table of contents. If you wanted to, you read the whole book, and so now knowledge is being created. The Age of Enlightenment occurs, and then the Renaissance, and that was the aftermath of the plague. So the bad news led to a good news. So today, Jerome Powell says we're recovering to a different economy.
I don't like talking, when people talk about the Fed, I'm instantly turned off because you have no idea what they're really talking about. All you can do is try to reiterate what the people on TV are told by somebody else. You have to run it through your editors. They're going to sort of spice it up or spice it down based on what they want to communicate. Based on your experience, reading what you read, seeing what you see. Just to chat on, here's where we were, here's where we are, and here's where I think we're going.
I told you I have a friend who's the senior economist or director at the Dallas Fed. And he reached out to me about 6-8 months ago, and he wanted my take on the economy. What he was basically saying is, you're boots on the ground. You're talking to investors and advisors. I'm up in this tower, running numbers all day long. And one of the stories I shared with him, he was unaware of at the time. I'm going to share the same story with you that I'm willing to bet most people just are totally unaware of. The Fed was created in 1913. And I don't know if you know why they were created, but it was the earthquake in California was the reason why. And what had happened was it wasn't the earthquake, it was the buildings burned. 1/3 of all the buildings in Southern California burned to the ground. And many of them were banks. California was the banking center of the West Coast. Well, the problem was the cash was in these metal vaults, and people wanted their money, and the banks wouldn't open their metal vaults because they thought the paper money, when hit with the air, would just burn up and incinerate. So they wouldn't open their vaults. And so they were going to friends and family outside of California going, I need to borrow some money. There were no rules on how much money banks had to keep on reserve. what would happen is they would liquidate all those banks' assets. And that bank would go to another bank going, I need to borrow some money. And then that bank would they would liquidate all those assets. And it just trickled and trickled and trickled and trickled until it hit New York, where it hit Knickerbocker Trust, the third largest bank and trust in America. Forget the name of the brothers. They were trying to corner the copper market. And they failed there, and the bank collapsed. They closed the doors, and they went to J.P. Morgan. We need to bail out the banks. And he'd already bailed out the banks in the 1880s. Now he's 70 years old, and he says, I don't have any more bailouts in me. He got all these wealthy bankers together in his library in New York. And if you haven't been to the library in New York, I highly recommend it. And so he gets them all in the library, and he locks the door. He locks them in the library. He says, y'all figure it out, and I'm going for a walk. And he comes back, and he unlocks the door, and they said, we need to create a central bank. We need to create a bank of last resort. And so they all met in Jekyll Island in 1913 to put this together. And one of the things they created was something called fractional banking, which is we have to keep a percentage of cash on hand in case people want their money, they have it. And that back in 1913, 1915 was 13%. And recently it was 10%. They can go up and down on this number. They rarely do. But back a couple of years ago, they changed that and they went to zero. Today, the Fed is not required, or banks are not required to keep any cash on hand. And so the Fed's been working with new tools. And some of the new tools are they now, when that 10% that banks had to keep on deposit, half they kept at their bank, the other half they kept at the Federal Reserve Bank. But that half that was kept at the Federal Reserve Bank, it was like a tax. They couldn't invest it. They couldn't do anything with it. They didn't earn anything. And so the Fed went, well, that's not fair. We should pay them something. So now the way the Fed adjusts money supply is called assets, interest on reserves, IOR, interest on reserves. And so what they can do is they can pull money in and out of the banking system based on how much they're paying banks to interest that they keep at the Federal Reserve. So today it's more interest on reserve.
If I'm not mistaken, they went to zero during COVID.
Right.
So they left it at zero?
It's still at zero because they created new rules. And so the way they used to do it, it was mandated. You had to keep 10% of reserve. Now they say if we want to take some money out of the system, what we do is we raise the amount of money we're paying interest on reserves. If we want to get more money into the system, we lower that amount, and the bankers are going, I'm not making any money there. I'll loan it out. I can make more money loaning it out. And that's how they're adjusting monetary policy today.
Banks are making too much money by saying, hey, if we loan it out, we're going to get a fraction of what we can if we just leave it with the Fed and get the interest on reserve.
That's how they control it. And that's what Jerome Powell was saying is we're recovering to a new economy because we're administering new tools. And that's what he calls them. There are new tools at the Federal Reserve.
This was a real treat. Anything else for the good of the order?
I do want to end with one thing, and I have a new presentation on artificial intelligence, which may be the one that y'all heard.
Absolutely.
My stepson just came in town, and he is the author of now his fourth book, which got listed in the New York Times on the front page of their weekend edition, and so very proud of him. But he's very concerned as a writer with AI, because his question, of course, is about his rights, the copyrights. I've learned a lot about AI and large language modeling, and his complaint is that they've used his 3 prior books in the large language modeling, and he said they didn't buy the books from me. And I said, well, I go to the library all the time and I borrow books. He goes, yeah, but the library bought the books. He says it's not fair that they're using my information and not paying me for it. And I agree with it. That's fair. So while I was doing this research on artificial intelligence, I came across a website that's now letting AI make stock selections. And what it says is it's going to rank the stocks based on 900 different fundamental, technical, and consumer sentiment indicators. And so it's following 10,000 stocks, and it's running 900 different on these 10,000, humanly impossible, just humanly impossible. It can do it every single day. And then it ranks them. A 10 is a buy, a 1 is a sell, right? I said, okay, I'll give this a shot. I'll put some skin in the game. And without doing any research at all, I just bought the top 3 names. Now it says to hold them for 3 months. So I bought them on October 16th, and I held them until January the 16th. And I wanted to see how did they do compared against the S&P 500. During that period, and this is October of 2023 to January 2024, during that period, let me see, I want to get these numbers right, the S&P was up 8.71%. AI down 16.18%.
Wow.
And let me end with this one story. The South Sea bubble. By the way, do you know where the term bubble comes from? Let me explain. Gold and silver had been discovered in America. And this is, I guess, the 1700s, 1600s. Gold and silver had been discovered in America. And London made a deal that if people wanted to go and mine the gold and silver in America and bring it back, they could bring it back tax-free. The London Stock Exchange was founded in 1666. The South Sea Company offered stock on the stock exchange to raise money to go to America to bring back the gold and silver. Sir Isaac Newton was an early investor because the stock is going up. And so he gets in, and the stock's going up, and he gets out, right? And the stock keeps going up. He gets back in. And he rides it to the very top, and it crashes worth zero. 88 more companies were formed to supply the goods and services to the South Sea Company. Build the ships, provide the goods and services. The ships were never built. They never went to America. They never brought the gold and silver back, and these stocks were worthless, and they were called financial baubles. And the definition of a bauble is a trinket of insignificant value. And Sir Isaac Newton said, I can predict the movement of heavenly bodies. I just can't predict the movement of the stock market.
Thank you so much for coming on. Really appreciate it. I'm sure the listeners will as well.
So much I didn't know.
And that's our job. That's my job, our job. Our job is to know what our clients know and know it well. Our job is to know what they don't know and know that as well. Yeah.
All right, Z, thanks so much for everything. Have a great Friday.
You're very welcome.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.